My name's Charlie Burgoyne. I'm the founder of a company called Valkyrie here in town. We do a variety of things, but you can think of us as Austin's private DARPA. We solve problems in consulting. We also have our own venture studio model where we inculcate different types of investment operations. Got a lot of social impact and some amazing philanthropic work, and then a large racing operation where we improve motorsports with algorithms. So today, we're joined by, going from my side over, Lauren Washington, founder of a company called FundrAi, an incredible platform oriented around basically mechanizing the state-of-the-art approaches for quantitative analysis against against the investment opportunities in the venture space. Think of this as the platform of record that's inbound for quantifying venture assets. Really excited to hear her talk today. You can think of her as almost representing the what of Moneyballing Venture moving forward. Next to Lauren, we have Lawton Cummings, absolutely an incredible part of the Austin community, a brilliant attorney who's been, I wouldn't say singularly focused, but a lot of your focus has been around the merits of artificial intelligence, the ethical nature of artificial intelligence, and as an experienced investor yourself. So think of Lawton's perspective as almost the how. Like how do we ethically deploy these algorithms? How do we think about these problems in a responsible way and deploy them? And then also how does that differentiate or perturb the whole industry? And then sitting next to Lawton is Lanham Napier, an early member of Rackspace. Took that company to amazing new heights as their CEO, president. He's been a very good friend for several years now. I look up to this guy about as much as anybody. And he started a very successful private equity fund here in town called Build Group a number of years ago. It's now matriculated into a couple of different subdivisions, including a really amazing SPAC. Lanham kind of represents the why. Why are we pushing this initiative? And one of the first conversations Lanham and I ever had was around how to quantify the venture space, and was one of our most exciting opportunities early on in Valkyrie days was developing components of his vision to bring that technology to light. And so we have the what, the why, the how, and to some degree, I think I can represent kind of the who's. I'll take the uber nerd perspective, given the fact that Valkyrie is kind of comprised of your biggest geeks and dweebs in Austin. But really excited today. Thank you guys for coming today, and we're excited to dig in. So I'm going to jump through a couple of questions really quickly, and I want to talk to you guys a little bit about why we're calling this program Moneyballing. So if we back up back up the story a little bit, Moneyballing was really all about transformational disruption through some quantitative approaches in baseball. And the super fun movie that came out of that was actually kind of an inspiration for a lot of us who thought about disrupting our own respective industries with this approach. I want you guys to think about, as we have this conversation today, I want you to think about how that level of disruption really resonates with your own personal charters. And so I'll open it up to you guys to dig in a little, to give a brief introduction and then say why this particular topic is important to you. And Lauren, I'd love me to go first.
Absolutely. Hi, everyone. As Charlie mentioned, I am the co-founder and CEO of FundrAi. So we are essentially bringing AI to help evaluate companies, move them through our process through a really fast close on our platform, and then track them long term so you can track your portfolio growth over time. So this is really exciting for me because I've been a founder for 8 years. I've worked on 4 different companies. I've built the largest conference for Black women tech founders in the world, and through that time have seen how bias can play a role within funding, right? I've experienced it personally, and then I've also heard it from the 30,000 women who are part of our organization. And so I saw an opportunity, truly just inspired by Moneyball itself as well, to really bring data and objective thinking into the investing space. And when you have that objective look into it, we're not trying to replace VCs, we're not trying to replace investors, but we're trying to use this as essentially a check and a way to open up and expand what VC could be and who can actually benefit from it. So really excited to be here.
I'm Lawton Cummings. As Charlie mentioned, I am an attorney. I have both practiced and been a law professor, and in both specialized in legal ethics and also in training clients on what their responsibilities are if you are leading or a board member for or an attorney for a company that is engaging in artificial intelligence. So, but I'm also now in VC. I'm a partner at Notley Ventures, have been for the last 2 years. I'm still bullish about AI and investing, just making sure that we know what it is and what it can do for us and how to mitigate any of the risks.
Hello, I'm Lanham Napier. I think what led me into this is, I cheer for the underdog. Okay, like it or not, I am an underdog fan. Okay, so when it comes to making investments, up till now, I do kind of think it's more of a relationship-driven game versus a data-driven game. And I studied a lot of economics. There's this thing called the invisible hand that Adam Smith figured out. Turns out it's not invisible at all, right? There are a few hands in a few places routing it around, and I think those few hands are geared toward a world as is, not the world that we want to be. So from my perspective, what led me into this was, how can one use data to get an edge, particularly if one is the underdog, right? Turns out I'm the underdog. So, I got into this looking for an edge. And with that edge, how can we put more variables into our decision making so we can find that needle in the haystack, or we can find the higher probability event, or I can find that thing that doesn't present as what I would normally think is the right thing, but because I got this machine telling me, hey, that's actually a pretty darn good thing, it's worth exploring. That's what led me to it. And I think the disruption that's coming is really for the underdogs. I think it's going to upend and allow people that have sort of the curiosity or the interest or the access to build these types of systems or this type of math or whatever you want to call it. I think that's where the revolution comes from, rather.
That's awesome. And kind of digging right back into that, Lanham, you were really a pioneer in a lot of ways of integrating machine learning approaches for the sourcing of different venture opportunities. How does the underdog play past that stage of the investment process, and how does machine learning push that into the next epic?
Yeah, so I think so I started, this path years ago. And look, admittedly, I've totally screwed some stuff up, dude, right? Just how it goes, all right? I've got scar tissue. Scar tissue makes for a good map. So what I would tell you is, when we went into this at the beginning, it was to find this edge. Then the question is, when you get past the edge as an underdog, how do you scale it? To me, what's interesting about, AI in general is the scaling comes in the data. The problem with private capital markets is the data kind of blow. So it's a little bit about how do you get access to the data you want so you can run it through the right models to get interesting insights. I think the scale point isn't a size thing as much as a data access thing, or as much as having a lens or a view around the data to where you can drive the insight, an unusual insight. And then once you love that insight, how do you, not to get yourself into sort of groupthink, but how do you find enough data to reinforce that and validate it, tighten your confidence interval, that kind of stuff. So from my take, the way to scale this is to be very thoughtful about data. And it's more about data, in my experience, than anything else. And figuring out how to, once we have a good data set, then it's about, some people make better models than others, right? Just how it goes. And then really having the Darwinian competition around that outcome is the next thing in my view. So I think, focus on the data and then just be open-minded.
That's really fascinating. So it's certainly moving towards an almost not exclusive, but a heavily quantitative approach. Lauren, from your perspective, you're building this incredible artificial intelligence systems into a product you're raising for, but the product itself is also designed to help companies such as yourself. Hearing that from a talented investor, how does that shape your roadmap? How do you think about your approach in a way that's differentiated, protected.
Absolutely, and you're probably going to hear us talking a lot about data because it's everything when you think about AI. The data can either help and find these diamonds in the rough, or it can bring in additional bias into the process, right? So a couple of years ago, I don't know if everyone has heard about this issue that happened with Google. So Google was testing their image recognition search engine, and they didn't test it on Black people. And so they ended up, when a Black person took this product and put their face in, we saw images of gorillas that came out after, right? So that's an example of what happens when you have bad data and when you have bad testing within an algorithm. There's good things that can come out of this, right? We can also show and remove some of that data as well, but we have to be really intentional about it. And so for us, that's exactly what we're trying to do at Funder. We're making sure that we're offsetting some of the bad data or some of the biased data that has come in. In this industry, for example, that includes data that's around funding, right? So we know there's a huge funding gap that exists right now, and so if you're only using data that perpetuates that funding gap, what ends up happening for a lot of these algorithms that have used this, we've only seen that white males in Silicon Valley are the answer to these algorithmic investment. And so we want to make sure that we're opening this up and allowing for bias to play a role, and we're removing that bias from the algorithm as well.
Yeah, while we're on the subject of biases, I mean, this is a perfect intro to talk through some of the real central concerns that Lawton has expressed and is thought through as a very qualified and prestigious thought leader in Austin around the ethics of artificial intelligence. These things are clear that there are some issues to be managed. I'd be curious to hear your thoughts about how these biases, transforming from convolutional issues to misappropriate species, right, in the example that Lauren brought up, to misappropriating sourcing and automated diligence, and who is going to be responsible for that extremely large challenge? Like, how do you think about those problems?
Yeah. Well, I agree with Lauren that right now one of the biggest problems in VC is that we have this gender gap. So only 3%, less than 3% actually last year, of VC dollars went to female-led companies. But female-led companies have been shown to produce 63% better results. So there's that gap there, right? And so if you have your data, I think the most important takeaway is that biased data can produce biased results. So it's all about this data set. And the algorithm can only be so good if it's going to look for a pattern of success. So how do we make sure, to your next question, Charlie, how do we make sure that we don't replicate that, so that we don't get the answer and say, okay, well, obviously we should be just funding white men only, and who's responsible for it? There was a great study that was published in November of 2020 in the Harvard Business Review, and the study had gone through and gotten these exact results, right? All of it came out with was go fund these white male companies. However, and so it beat the junior analysts. They put the algorithm up against junior analysts and up against senior investors, and senior investors beat it. So what this shows is that with experience, investors actually come to control their biases. They come to see them and overrule them. So if the algorithm can be used and seen, at least in its current form, as a suggestion or producing possible outcomes rather than the actual decision, or perhaps down the line we can have AI that trains not just on successful outcomes, but also on what senior investors do. And then that way we can solve for this problem.
So to kind of frame the opportunity for us to discourse a little bit around that subject, biases, artificial intelligence has to inculcate some degree of bias, otherwise it wouldn't be an intelligent system, right? This is the question is whether or not you embrace those and you control those to be altruistic at the same, or ethical at the same time. Lanham, when you guys were pushing forward with automated sourcing through these machine learning approaches, what stuck out to you? What did you find your team thinking about more often than not? The data itself and how it was going to be collected, or the methods through which those data were utilized to down select the sourcing?
Yeah, I think we were thinking about a different axis the most, actually. And what I would say is, this is one of the parts I think I totally screwed up as the leader, okay, full disclosure, is that, when the machine, whatever you want to call this machine, okay, so I call it a Solomon because I like Proverbs. I think Solomon was a stud, anyway, all that stuff. The problem is when Solomon says, hey, go look at this one, and then Harvard Business School graduate over here is like, it's like you get this human versus machine thing going on. And what I wish we had done was had more of a collaborative approach to the machine out of the blocks. Instead of this machine almighty, the questions we were asking were, we couldn't get to bias until we were through this UI problem, with the machine. And so I think, as we went down that path, I would just say, from day one, so I'm in another iteration of this now. It's about, look, we're going to partner with the system. That system's going to make us better, and we're going to make it better. And, this is a journey, not a stop, not a point in time. There's a human in the loop, so we're just going to reduce that, fear factor for people. That's the stuff we end up talking about. Because then, once we get past that, then we can get to, what's our bias? Are the data flawed? And before that, I was just trying to really, create a diagnostic around the confidence intervals for the decisions we are already making. As humans walk around all day long, I love that one, boss. That one's awesome. It's going to be great. And I say, okay, on a scale of 1 to 10, in the book of you, how great? And then there's this pause. Well, how much do you like it? Oh, I love it. Okay, on a scale of 1 to 10, how much do you love it? Pause. So I think forcing people just to be more quantitative in their assessment of things, then you start to get some base rate. And with that base rate, you can infer things, and then, taking that base rate to compare what the system is saying and to get a tighter projection or a tighter confidence interval, I think that's a good way to do it. And getting through that first trust factor thing, that's what popped up first before any bias. I read this cool article about the Air Force has these, self-flying planes. And when does the pilot grab the stick? Right? This is super interesting, right? It turns out humans have a little different risk tolerance, than that machine. And so we had the same problem, right? And I think in investing land, taking on the systems is akin to grabbing the stick.
Lauren, how do you think about hearing that? I'm sure this is something you thought about the inception, the crucible of Funder, right? But how does that really affect your allocation of hard-earned dollars of investment capital? How does that impact the way you guys invest in the development of your platform? Do you orient around primary and alternative data sets and getting really creative around how those commingle, or do you obsess over the acuity of these models so that it's extensible and scalable? Or I'm sure it's a combination, but how do you think about that problem?
It's definitely a combination, but I'd say for the phase that we're at, we're really focused on the data right now, and particularly primary data, right? So I think a lot of these companies out there like PitchBook and Crunchbase, they're incredible, but they don't always have firsthand data. They don't always know exactly what the revenue is. I know a ton of founders who have raised significantly more than what is posted on those platforms. And so what we're trying to do is really make sure that we have that primary data, and then that we're checking it with third-party sources. So we're looking at LinkedIn, we're looking at their customers, we're looking at their overall growth, we're connecting into Plaid and checking their revenue growth and all of those different things. And that gives us a really big leg up in terms of how we're creating these models as well. So the first stage for us is literally all about the data, making sure we have the best data, and then we can build the models on top of that because we're actually tracking them on a monthly basis, and we can see how they're growing over time, and we can take that growth and say, well, this company just got bought really quickly within 6 months. What were the factors in a original algorithm that we can learn from, right? And then we can pull into our machine learning and add, and then that will sort of shift and change over time. So we didn't want to use historical data because, again, as we've talked about a few times, we've seen that the answer to historical data tends to be white men in Silicon Valley. But what we really wanted to do was say, if we start all at the same point with all the same data and we're growing on a monthly basis, we can truly find what those 2 or 3 factors are over time that will say what a successful company is. It's going to take more time to do that, but I'm really excited about how we can build that and how we can grow with this incredible data up front.
So I'm going a little off script here because I think this is a super fascinating tact. And Lawton, I want to ask how this how this really interesting nuance that Lauren brought up resonates with you. You know, Lauren made a very small point, and I think this is super important, that tuning these models, getting feedback to what's successful and what's not successful, something that they actively do. Now, that is going to face a transition where at some point these models will start self-healing. They'll be intentionally designed to do that on their own instead of having the bespoke, which is great for scalability, but that can introduce a lot of implicit issues and kind of an echo chamber of biases sometimes for a model. We talk a lot, in fact, we talked earlier today about a different talk today about the difference between an unexplainable but sometimes more accurate model and the implications that has, and then very explainable but bespoke models. How do you think about, from an ethical standpoint, how venture capitalists need to think about this balance between these self-healing models that Lauren is road mapping and is going to have to be responsible for, and then their ability to be attributable and responsible?
Yeah, it's a great question. It's a knotty problem. I definitely believe that right now we need this reinforcement learning rather than unsupervised learning, like coming back to what Lanham and Lauren were referring to. But then eventually, right, we're going to have, algorithms will get more and more and more evolved. So it's a balance. I mean, I think about Jonah Hill's character in Moneyball, when it came down to identifying the most undervalued player, right? And so what was it, the human bias that's really what these computers can solve for. It's not just speed, right? Yeah, it can cut your funnel down because it can go through and source and it can screen, but it's a lot more than speed that we're wanting. We're wanting that diamond that we didn't know existed. And the bias in Moneyball was the guy looked funny, threw funny. So where is it that looks funny, throws funny, but that's not something that we don't, in our society, we don't want to discriminate based on race. We don't want to discriminate based on gender, age. Those are our values, but it's also good money, right? So if you can find not just, okay, we know there's a gender gap. What other gap is there? Some funds found there was a gap looking for just the fancy education, college education. Is it the gap and you're not on one of the coasts? What are those surpluses that we can find from the algorithm? And that's where the Holy Grail is. So if the decisions in the meantime, where we can say, okay, reinforce, we don't want to make a decision based on that's whatever reason, but then also looking retrospectively, going back over time, and having huge data sets is, part of the problem with democratizing VC is you've got to have a big data set. But then also your data set. You've had this data set of your decisions, and when you overruled, when you didn't, and well, that one exited, that one flopped. And so eventually over time, I see them more as individual bespoke. And so it'll be Lanham's AI-assisted decision-making process with his data, which would be incredible, versus Charlie's, versus Lauren's, versus Lawton. And that's when it's really fun.
I love that. So I'm going to wrap up on this first goal, where really what we were thinking about is how does this get deployed in a way that is tenable, right, for the field of venture. I want to instead shift gears a little bit to thinking about artificial intelligence approaches, how they've failed, and why these approaches that you guys are discussing right now have been successful for you, and how you think about how they'll be successful moving forward. And I'll share just a brief perspective that we developed at Valkyrie the last year, observing all of our clients over the last 5 years now. We saw that really there are kind of three different reasons that artificial intelligence projects fail. Right? There's the mechanics, the capability itself, designed by the scientists, developed by the scientists. That's almost never the reason these projects fail. Scientists don't usually go down that path very far before they start realizing it's not going to work out and they back out. Sometimes it's the methodology, so the business operations, the key metrics that need to be impacted, and marrying that with the mechanics itself have issues. Right? The system rejects it because it doesn't have an impact on the system. And then there's the mentality issue, getting a culture to adopt that, getting a culture to bring on platforms like Fundr, getting a culture to bring on consider the implications of the decisions they're making in the system, the thinking about designing a new team of investors based off of this really powerful technology. If you guys were to crudely summarize why embrace that treatise, that artificial intelligence, 85% or so that Gartner projects that Gartner says fail. If you were to embrace the treatise of those three being the cause, I'd love to talk about what that's made manifest in this domain. So, so Lawton, what do you think actually has the most impact from your perspective when it comes to the deployment of these techniques? And the resistance of the industry to accept it? Is it the technology itself? Is it the way that they integrate with their business processes, or the mentality of the culture?
So from my perspective, it's the methods. People don't really understand what it is that it can do, and both limit it and don't see its limits. However, listening to Lanham's description, I mean, the adopting and the mentality, I guess that can also influence. But where I've seen it really go awry, that's where, oh my gosh, this is going to be so great for this company, and then they're just not using it the way it should be used. They think it's something different.
Mm-hmm. Landon, how does that
I'd add on that.
Yeah.
I would just say it's about alignment and expectations. So I think for people that aren't super, mathematically inclined or tech deep, the expectations can be, woohoo, I just found Jarvis. I think for people that are inclined that way, it can be disappointing. So I think it's about how we frame this around, look, this is a tool. It's actually not Jarvis, but it's a pretty good first step. And we're to take this step now, we'll iterate, we'll learn, we'll get better. I think it's like you got to, in my experience, it was the stuff I screwed up. I didn't frame it long enough that, hey, this is going to be a multi-year journey, home slice, prepare for the madness, okay? And then after that, it's, being clear about what a win looks like, and that gets back to the right expectations. Because at the end of the day, this is just about reducing risk and increasing gain. That's all we're trying to do.
Mm-hmm. And Lauren, when you're thinking about how to, because the central business model for Fundr is making sure this tool is utilized, adopted culturally, and is also hitting against the value for your users. How do you try and weight insulation against those three M's?
Yeah, I would say what I'm seeing right now is more around the mentality piece. I joke that VCs love to use AI to disrupt every industry but their own. And so I think right now we're really trying to bring this AI into this industry, and there's pushback, and I understand that. It's scary to have something that you may think is taking over your job. And I'll say we're in a very nascent early stages of AI in VC, right? And like Lanham said, it's a tool right now, right? And how can you start integrating that tool into what you're doing so that when it starts taking over and when it starts playing a larger role in either evaluation or decision making or the follow-on investments or however we're using this, that you're a part of it, right? And so I think that's where we're at right now, is that mentality to make sure we are seeing this as a viable addition to how we're building up VC right now.
So all three of those perspectives, I think they really resonate with our team as well. I mean, we attribute it, these failed programs that we see in industry, it's almost always a combination of the mentality and the methodology. This mechanics are actually, again, usually pretty robust. Not to, of course I would say that when we're the guys building it. But going as a shameless plug, going down that path, Lanham, we were talking in prep for today. We were talking about. I said something very pedantic about how what's the big catalyst that's going to create change, and how long is it going to? What do you see the future looking like in the next 5 years? And you brought up a really interesting point about how this is actually a generational evolution. Do you want to talk a little bit about that perspective?
So, look, as official, 51-year-old bald guy, I have a smaller brain than younger people. And so, my thought on this is basically, I think, so I look at my kids. I got a 21-year-old son, 18-year-old girl. The girl runs the show, big brown eyes, highly influential. But what like in my family, in my life, the way this happens is I look at the skill set, my children have, as far as the ability, like I'm a digital immigrant, they are natives. That is their, they live in a metaverse. People my age are trying to figure out what the heck that means. And so I think the difference is for people from that ilk, that generation, I think they will be so much more accepting of these outcomes and more, I just think, I have this phrase about whether the feedback office is open or closed. And I think their feedback office is significantly more open on this, than people of my generation, for example. So I actually think it's a little bit where the way the disruption flows is that you have the establishment old guard, me. You have the up and coming, aggressive, people that think in a different dimension, my kids. Part of that dimension for them is digital data, AI. I mean, they expect all that, and I think they're going to have it. So my take on it is the way this goes is not, I loved your quote, Lauren, about, I wrote it down, VCs like to use AI to disrupt every industry but their own. Look, I'm just glad I'm old enough, I'm not gonna get disrupted, dude. I'm almost out of here, baby. Okay? And my kids are gonna be playing Pac-Man on people like me. That's like, my kids don't even know what Pac-Man is. All right, so I just think this is the difference, is I think that generation is gonna be the one to pull it through. Sure. It's not gonna come from folks like me. I'm experimenting, dabbling, kind of thing. They're gonna own it.
So I want to dig in on this. I'm so sorry, guys. We had this elegant script, but I'm fascinated with a couple of these points that are coming up. Lauren, as we have an evolution of, I totally believe what Lanham's saying. Let's just pretend that, for argument's sake, that is exactly the case. When you're thinking about how you're insulated as a product and I'm sure a platform down the road. How do you think about how either the relationship between individuals and their own private data is evolving, which we've witnessed a huge transformation. The individual's relationship with privacy has just wildly evolved, especially during the pandemic. Do you think that it's the case that pitch books of the world are going to have more access to the same types of things that we're hunting because of the relationship with privacy is going to evolve? Or do you think that as we see growing techniques in using inference across domains, being able to predict fish markets in Japan based off of cotton markets in Argentina or whatever the dichotomy is, what do you think is the best way for you to protect Funder's competitive edge?
Oh, it's a great question. I think when we first started, we started talking about how hard it is to get access to private data. And I think that still is true because founders tend to hold that data very close to their chest, right? We want to use that data to create the stories that we want to create because that's actually just how it works right now, right? When you go into a pitch, you use your data, you show that hockey stick growth and where you're going and all of that. And you want to make sure, even with things like information rights, that you are sharing the things that need to be shared with who they need to be shared with. And that's really important in terms of protecting your company, your IP, a lot of different things in terms of being a founder. And so I don't see that shifting anytime soon where it's all out there on the market, because there's an advantage to not sharing it. But what I'm seeing in terms of Funder is that they're getting more comfortable with connecting to things like Plaid, right? And you can come into my bank account and pull that information from me. I don't want to actually upload this. If you can do that, that's fine, as long as they have some controls over who is seeing it and where it's going. And so I think that's always going to be a competitive advantage, at least for Funder, or at least for anyone else who's building this out. Having that first-party, first-person data is incredibly important. So I don't really see that shifting over at least the next 5 to 10 years. Maybe we will get to a point where it's like a public market, but at this point, I think that's still a competitive advantage.
And Lawton, as a kind of a related question, I think I'm a baby boomer trapped in a millennial body sometimes. And I was talking to my baby sister, is a scientist as well in a similar field, and I was talking to her, and I said, Facetune, we have got peers and near peers in the geopolitical stage who have complete access to apps like Facetune and TikTok. Doesn't that bother you? And she's like, so? I don't care. I couldn't care less. It is really remarkable, I'm sure as an attorney, to observe like our relationship with the idea of privacy is evolving so much. How do you think that's going to impact not only this industry potentially, but other industries as well? And how does that fit into your perspectives around the ethical nature of artificial intelligence?
Well, I think the other trend that's happening right now, of course, is blockchain. And so I actually see privacy as being grabbed back. So for a long time, we had the corporations, the big ones, Google and Apple, and basically if you wanted your map to work, you needed access, right, to where you were. And it's actually generational, but also just person-specific. My husband loves getting ads on Facebook and Instagram. He calls them his personal shopper. And so he is always like, yes, you can follow me across. Yes, you can. And for me, when Google had their facial recognition, their Google pictures, I'm like, hell yeah, look at all this great stuff I can do. I can show my kids from when they were born till now. And so it's person-specific there. And I have similarly aged kids, and they don't put out there the information people think they do. They will post maybe once on Instagram a month. They're like, ew, who posts that? That is way too personal. They'll put that on their private story. And that's private. So I think that I see that happening. And now that blockchain has come about, and we're not going to have to disclose who we are if we want to have fractional ownership over an NFT or a home. And I think as an attorney, I'm kind of glad not to have to figure this out. The IRS is just probably pulling their hair out. But so I do believe that some of this information is going to continue to be closely held, and that it's this tension, right, between, it used to be that someone like Carta could say, if they ever wanted to, hey, we'll give you free services if you'll just tell us all of this information, which is what we used to do. And if that would happen, then this would be really democratized, what we're talking about. But I don't see that is what's going to happen.
Mm-hmm. That's super fascinating. And I'm sure actually, it's terrifying for Lauren and for Lanham as well. To create these auxiliary personas. If everyone acted the way your kids do, then at scale, that'd be a real problem. In order to try and accurately measure and predict, you get a lot more Elizabeth Holmes than truly valuable companies. We at Valkyrie, we were lucky enough to hire the founder of the city of Austin, Liz Kofel, and she's always trying to encourage me to have like a public persona that's not actually me, and then my own persona. I can't really reconcile that, but I'm glad that some people are figuring that out. So I want to wrap up, make sure we leave plenty of time for questions, because truly, I'm not being hyperbolic, these are three of my absolute favorite people in the city. Just real quick, the year's 2030. You guys are all running your own funds. Fender's had this tremendous, exciting exit. Of course it will. Lawton is running her own fund that's oriented around ethical AI, and Solomon is now this behemoth. What percentage of direct VC deals that you guys are all working in have AI touch their process? And there's an easy answer to that, but dig into how you think about what that evolution will eventually look like.
Well, for me, I think it's maybe if you fast forward 8 years, if people are making investments today, I think it will touch all of them. Now, it may touch them in a different way. It may be something that's sourced. It may be something that highlights risks. It may be something that highlights a term that you really ought to negotiate for. So I generally think terms are way undervalued. It's easy to value something that's quantitative. A term's kind of hard to quantify. Right? It could be a little surplus in a term. So my view is I think it's going to touch all of it. It's just a matter of where. I doubt 8 years from now it is the whole system. I'd be short that idea. I'd be long the idea that it is active and touching it.
Closer to augmenting what we do today as opposed to artificially doing what we do.
Yeah,
today.
look, I'm still in the human plus AI equals Titan.
Yeah.
But we'll see if that comes true or not. But I believe it. I'm an optimist.
Lawton?
I agree with Lanham 100%. I'm bullish on AI will touch 100% for any successful VC. And I wrote down the word Grady because in the film, when the scout was telling Billy Bean, Brad Pitt's character, he's like, I'm not going to follow this computer, and this is the way we've done baseball for 150 years, and it's intuition. And one of the most famous lines was Brad Pitt said, adapt or die. And I think that's right. It'll touch 100% of any successful VC because they just won't be able to compete. If they don't. Yeah.
I 100% agree. So last year, a study from Gartner came out that said AI is going to be in 75% of VC decisions by 2025. That's in 3 years. So that's 75%, 5-10 years. It's absolutely going to hit 100. Is it going to take over? No. I think there's going to be a combination of AI and people. And using AI as a tool in order to make better decisions, to maximize returns. And so I definitely think there's going to be a shift, but quant investing has been in all areas of finance for decades now, sure. Right? And we still have people who are working in finance, just their jobs have shifted. And so I think that's what we're going to be seeing in the next 5 to 10 years.
I love that. So everybody came to hear you guys talk. I want to editorialize on this last point because I think it's really fascinating. This is we get exposed to a lot of different industries, everything from cruise ships to Formula One teams, all sorts of weird stuff we get to see at Valkyrie all the time. And I actually think I haven't found another industry that is as systemically flawed in a lot of ways as venture, but yet the people within venture absolutely want to change, but it's a sector that is inherently dependent on a very confined network. Mm-hmm. What I genuinely think is by 2030, we'll be in a position where the democratization of these tools really empowers much smaller funds to evolve and be competitive in ways that we haven't seen before, and that it's actually going to be harder for a benchmark or Sequoia to be competitive than it will be for a small fund, two people running the fund with 50 million AUM, something quite a bit more flexible and dexterous. So. I think we dealt with a lot of this with retail in the mid-'90s, thinking that Walmart was going to destroy everything. Well, Walmart's, all we need is oil to go to another $10 higher, and Walmart's in real tough shape. And Amazon actually kind of brought back the mini guys. Not that I'm some defender of Amazon, but you get where I'm going. Is that the tiny guys are back, and it's thanks to these flexible platforms. So I want to thank these speakers for just being incredible people, contributing so much to the city of Austin, and for sharing your thoughts today. And with that, I'll open up let's give a round of applause. And we'd love to hear any questions, so please feel free to walk up to the microphone, voice it through the mic, and yeah, thank you.
Hi, this is a more of a question for Lauren. So right now, I wanted to get your take on where you see AI performing the best as far as the stage of investment. Obviously, with like a pre-seed company, there's not a whole lot to work with except a founder and a dream. So I just wanted to get your take on that.
Yeah, so we are actually in the pre-seed seed stage, and I think that's just because we see the most opportunity there. So there are definitely models that are at Series A and beyond, right? Once you get to Series A, it's more about the data, it's more about your traction and your revenue, and a lot of people have models already set, even though they're not only using that. I don't know if everyone is familiar with Social Capital. They essentially only used algorithms in order to build up their billion-dollar funds, and they were at the Series A stage. I spoke to someone from there, and they said that they did not have conversations with their founders first. They literally just put them through this algorithm, and they had a significantly higher IRR than a lot of these other funds. They were able to grow until they sort of imploded and closed. But I think there's huge opportunity in the early stages. I just think it's access to that private data that we don't have, right?
Yeah.
So how can we make sure that we're looking at your traction, we're looking at the marketplace, we look at team, and there's ways to quantify those things. You know, we can quantify how many years you spent in the industry that you're building your company in, right? We can quantify, what is your competitors and what does the M&A look like in that space, right? And add those things into the algorithm. I just don't think we've done that as much because the mentality right now is around, like you said, a founder and a dream, right? Or I like to invest in the person, but there are metrics there, and I think we're able to really break those down. It's just in the early stages right now.
And I have another follow-up question. So do you see potentially Web3 where everything is public and open and transparent? As a founder of a Web3 company, like we're planning on publishing anything about pre-seed for revenue and what the deal terms look like and such. Like, I know that may not be reflected on maybe a pitch book or Crunchbase or anything like as an aggregate or as a place for you to pull that, whereas like maybe those are published in like a tokenomics model or Discord or something. But do you see that as a way to increase those models for pre-seed and seed?
Absolutely. I mean, you're seeing it now with ICOs, right? And those have been around for a while. And so I think there's always going to be a subset of companies who are comfortable sharing that information. There's going to be a lot who are not comfortable, right? And I think it's going to be a shift over time. But I think, like Lawton said, bringing blockchain into things, bringing Web3 into things is absolutely going to have an impact on this industry. It's early, so we'll see exactly where it goes. But I think we're already seeing with crowdfunding, with ICOs, the ability to bring in public and additional data to make those decisions.
Awesome, thank you.
Thanks.
Interesting question for you guys. So I'm a founder as well. Let me ask you a question. Let's say you have an imaginary country where everybody walks barefoot. Somebody comes in and says, hey, I want to sell shoes, and I want to invest in a company to sell shoes to all of these folks. So you have, on the one hand, someone that goes, well, no one's going to buy shoes. That business is going to fail. On the other hand, you say, this is a great market. Nobody buys shoes, or nobody has shoes. I can sell it. What I worry about with AI is a lot of times you have to look at the founder, and it's a little bit of a leap of faith, but you can have the exact same metrics, but two different people. How much faith, how much force of will, how much power, breadth, depth is this person going to put in this venture? My worry with AI is if you just look at metrics, I think that tells a smaller part of the story. So I'd love to hear from all four of you, because this is where things get fuzzy. And if you're going to invest millions of dollars, right, that's a big bet just to make on a few metrics. So I'd love to get all four of your guys' take on that.
Okay, I love the question. I do think, so one of my favorite things is to create a proxy variable for grit.
Yes.
I think grit's this amazing, concept. And some people sort of have it innately, others develop it. And I do think there are proxy variables for that.
Do you have a gritometer? I would love to buy it. How do you?
Well, we can talk later. How much money you got, home slice? So I just think that when you think about grit, for me, there are variables to look at how people respond to failure in their life.
Yes.
Immigrants to this country and all the obstacles they overcome to get here. When, Lawton and Lauren are talking about people that are, biased against from a fundraising point of view, right? That requires grit. So I think if you're talking about the shoe salesman on the barefoot island country, the grit to change people's minds to the benefit of a shoe, and then for whatever your endeavor is, think about the proxy variables and indicators of what grit are. The kid who grew up on the wrong side of town who somehow made it to university. The kid who grew up in an alcoholic home, like that kind of stuff. The child of a single parent, or a single parent doing this, right? To me, all these things are amazing proxies of just the resilient system that is that human. And I actually think you can quantify that. Now, look, it's going to be a fuzzy logic thing, not a specific thing, but fuzzy logic's good enough. Turns out impressionist artists are kick-ass. Okay? Impression art looks a lot like fuzzy logic to me, and that stuff is priceless.
Yeah, it's a really good question. It's a hard one, and it's one of the reasons why most all of us, our deals, I would say, or I don't want to speak for anyone else, but most VCs get their deal flow from people they know. And that's part of the problem that we're trying to solve for. And also repeat founders, right? Because we know they're successful. So, because there's someone who knows them well and can vouch for them. So these are the problems that we're trying to solve. And we can't be everywhere and know everyone. And how do you find that? I mean, I wrote down the proxy for grit, which I love. But even grit is slippery because if you were to, there's a great book called Range, which I love, by Epstein. And one thing he talks about with grit is you need to know that you're actually, when you're testing for something, don't test for, oh, they stuck with it, right? Because the people there was a study where they said you can measure if someone dropped out of West Point in the prior summer, you're trying to figure out who would drop out in the prior summer so that you wouldn't get those people. And then he's like, you know what? Those are the people that you want because they will say, hey, this isn't for me early and leave, right? So they have the grit to walk away. So it's coming up with, and that's why I think this experienced investor, and also I think that the bald heads do have bigger brains than the young ones, only because we actually do have brain plasticity, so we are adding, but also we have that insight or the wisdom that you gain. But how do you put that into your algorithm? Well, that's what makes it so beautiful, right? That's what makes it the art, coming up with it and doing your own. I can't wait to see Lanham's data someday. It's going to be incredible.
Yeah. So I'd agree with Lanham in terms of being able to measure personality and characteristics of a founder. That's actually part of the measurement that we have in our algorithm. So we use the Big Five personality assessment, which is the only assessment that has been connected to showing whether someone is going to be a successful founder over time. So that's part of our data, but I don't think you can really separate the founder from the business, right? So who is running that traction, right? So if we're talking about the data and the business, who is driving that traction? Who's driving that growth? Who's driving those shifts and the pivots and the changes? It's the founder, right? And so I think, yes, you want to make sure that you're using the ways to assess their characteristics, but you can also see through the data what that founder is doing as well. So I think they kind of go hand in hand.
Yeah, I think we at Valkyrie have a tendency to over-intellectualize things, but when we look at founders that are or opportunities to make investments and partner up, grit definitely plays in, but I also think that there's a bit of scrutiny that needs to go towards how correlations versus causations within the market and the product fit actually play in. Like, is the island barefoot because they've never thought of shoes, or are they barefoot because they all adhere to the same deity that says don't wear shoes? In which case, we found that a lot of, this is kind of getting a strange metaphor, but we found a lot of founders don't actually think about that problem. And sometimes we're the first people who have asked them to go not 2 Ys down, but 5 Ys down into their the state, the raising Dalton's detriment for their business. So we think about that a lot. What's the correlation of different facets of what they offer? What's the market looking for? And what are the causal impactors for that? But also the 5 Ys need to go deep for those individuals as well. Like, what is the motivator for the founder? Are they trying to sell shoes on this island and then have a great exit on a yacht? We probably will pass on that. In fact, I'm pretty reticent usually to get involved with folks who have a very well-defined exit strategy, which is kind of antithetical to most investment theses. But I like folks who say, well, look, the exit is not relevant. The charter is. And if we are limited in resources in terms of being able to realize that charter, and we need to get acquired or we need to go public, then that's what we'll do. I will get excited about that company all the time. But if they come in and they get whizzy and their hair gets slicked back and they're like, guess what, we're going to exit in 4.5 years. I'm like, no, you're not, and we're not going to help you with that fallacy. So, sure, great question.
Yeah, thanks so very much. George Bloomberg from Inspirant. So thanks for the great panel. I love the point about VCs loving to disrupt every industry with AI except themselves. It's something I heard, I think, 2 years ago, that McKinsey is predicting every industry to be disrupted by AI except consulting. Right, so there's a repeating pattern there. So maybe in light of that, I've been running an AI company for about 5 years, and one thing that I see as a repeating pattern is that AI and humans are really good at different things. Right, and Lawton, you mentioned AI plus human is a titan, and we got some tech experience on the table too. So I'm wondering, if we think that AI and humans are good at different things, what is the optimal work split between a human and AI, particularly in an investment process, maybe from a process point of view, maybe from a tech point of view?
Yeah. So my take on this, I think it's a fascinating question. Generally, I think of AI as X-Y axis, and I want humans to be the Z. So it's a little bit that it's how do we, at least, so far, okay, it's about these different swim lanes, and which ones lend themselves. Obviously, if we're in a, investment business where we're trying to close over supper, hard for the AI to pull that off, right? But, up until that, pretty darn good. Okay, now look, maybe one day we'll roll out the avatars and the AI will close it over supper and I'll go play ping pong or whatever. All right, but we're not there yet. And so my take on it today is I want these things to be symbiotic. So I don't see it as either or. That's why I want to put a plus in there. I actually want there to be a feedback loop going each way. And I believe there is. Because I think we're all learning critters. The system's a learning critter. These humans are learning critters. So I think we will get better. And for me, so today, if I were to break down on 10 units, how many is on AI, how many is on human, I think across the industry it's 8 human units and 2 AI units. Where this goes over time, I couldn't tell you. All right, I just think the AI units are going to grow over time because I think it's early stages, early innings. All right, but I also think as those AI units grow, the industry's just going to function differently. Humans will be doing other things.
Maybe just specifically to that, and when you predict on how basically the time spent on these processes are going to change, do you see them specializing in different parts of the process?
Yes. Yeah. Look, so at the end of the day, where humans can specialize in a way that I think is superior to AI for at least the rest of my career is on human-to-human interface. It's hard. I mean, I made a comment about Jarvis earlier. Man, that guy's pretty cool. All right, but until Jarvis is running around, I think it's going to be tough for an AI to sell me. Now, I'm old and crusty and all that stuff. Okay, but I think human-to-human interface, really good. I mean, particularly if you think of an application like healthcare. Like, do you want to be talking to a human about your problems, or do you want to be talking to a machine? I don't know, maybe everybody's different, okay, so I don't want to project. But I think in the sales component, in the human-to-human component, I think the biological organism has an advantage.
Okay, maybe someone from the tech side?
Yeah, I would say right now the opportunity is in evaluation and potentially in due diligence. and in the early stages of evaluation, right, where you're just kind of getting a lot of deal flow. So we have a lot of investors on our platform who are like, I have thousands of companies, and the only ones I actually talk to are those that are warm introductions. But which ones am I missing, right? What are the diamonds in the rough in there that didn't come through the warm introduction that I don't have time to get to? And so I think that's where we're seeing a lot of that application right now. But I do see a shift eventually. I think eventually that's going to be building up over time. And then we talked a little bit about the speed coming in. And so if you need to get into these deals really quickly, an AI can evaluate them so much faster than a human can. And so I think that's going to change to that human and human interaction of now I'm helping you grow and build your company. Now we're building out our platform services around you versus spending so much time in those early stages of evaluation and due diligence.
Great, thank you so much.
Thank you. We have time for 2 quick questions, hopefully. Am I on? Yeah. I don't know.
Sorry, I've just got one question, super quick. There are many underfunded sectors out there, one of them being the create tech industry, which is one that I'm personally in. And so how can AI be used to help VCs understand these spaces and therefore get those underfunded founders through the door?
So I can jump in. So I'll say that it can really help in terms of understanding apples to apples in terms of what you're looking at. So we actually have a lot of investors who are on our platform who you think that VCs know every single space, but they don't, right? And so they might say, oh, I really love biotech, or I really love creative tech, or I love CPG, but that's not my area. And so I don't know how to evaluate this. I don't know what the comparisons are, but when you pull data in and you can say this company is growing 70% faster than a similar company in that space, that's really huge, right? That's the kind of information that can shift markets. And so I think that's really what we're seeing in the early stages in order to help remove some of the bias on the industry level.
Yeah, and the reason I paused initially is that most often you'll have a VC fund that's focused in certain areas of their expertise. And so perhaps this can help broaden those areas. Because right now, that's definitely the way it's, or even different, say you have fund managers within a large fund that have their specialty. But perhaps it could broaden it.
Okay, thank you.
Hi.
Last question. This is it, yeah.
No pressure. No, I just wanted to ask a little bit more on the tactical level, right? What types of algorithms have you been using? What type of variables are you seeing them being the most relevant ones when you're doing it?
Want me to go nerdy? Talk nerdy to me. No, so I'll answer a couple of this. We've now done 3 projects with different investment firms, 2 banks, and we're about to start our 2nd insurance company. So we think about this problem a lot. In short, we've done a lot of experimentation with multi-armed bandits, techniques in reinforcement learning to try and replicate the abilities of a partner to evaluate the different features within that profile of a particular company. We've had mixed results with MABs. Really, it really comes down to the fidelity of the data that you're collecting for them, right? How much you can actually gather. And then there are a number of different regression approaches that we've taken on to try and make the most use out of the features that are available. One differentiator that Lanham and I had developed years ago and talked about was the ability to actually think about some of these categorical features for a company dynamically as opposed to statically. So it's not about how many people have you hired in the last year. What does the function itself look like of what hiring had looked like and what you did once capital was injected? So creating classifiers that based on the basic multifunctional analysis that was quite effective. So there are techniques, lots of techniques to do that. Support vector machines can be valuable to develop those. Gradient boosting techniques can be valuable for that. We did some deep learning stuff early on that, but it's really actually, it's not really the best approach for most problems, and this one in particular. And then our secret sauce all revolved around the deployment of graph algorithms in graph dimensional spaces. So, yeah, we really appreciate you guys today. Thank you so much for coming in. Have a great, safe South by, and have fun.
Thank you.